Investing is like a battlefield. Two core strategies exist: offense and defense. Both can lead to victory, but knowing when to use each is crucial. The worst mistake? Fighting a battle you're unprepared for. An offensive strategy means allocating part of your portfolio to high-growth opportunities, assets with greater return potential, but higher volatility. A defensive strategy prioritizes stability, minimizing short-term market fluctuations in favor of steady gains. Warren Buffett, one of the greatest investors that ever lived, once quipped, "Rule number 1 is never lose money. Rule number 2 is never forget rule number 1. The Oracle of Omaha's advice stresses the importance of avoiding loss in your portfolio. It's about protecting your capital from losses. Safety first before focusing on enhancing return. Know your risk tolerance. The real struggle for most investors isn't picking bad assets. It's choosing a strategy that matches their temperament. Ask yourself, are you comfortable with big market swings, or do you prefer steadier growth? Many say risk tolerance is based on age. Younger investors can take more risks, while older investors should shift towards safer, income-generating assets. Why? Younger investors have time to recover from downturns and don't rely on portfolio income. Retirees have fewer recovery opportunities and may depend on their investments for financial stability. That's why traditional advice suggests shifting to safer assets over time. More videos will be made on this topic in the future. Make sure to subscribe so you do not miss them. But risk tolerance isn't just about age. It's also about psychology. A young investor may have decades to recover from losses, but that doesn't mean they can emotionally handle watching their portfolio drop 20% in a week. Some thrive on volatility. Others panic and make poor decisions. The key is understanding your personal risk tolerance. It's better to accept lower returns with less volatility if it prevents you from panic selling a good investment. How to test your true risk tolerance. Invest a small amount in a volatile asset and observe your reaction. If a 20% drop keeps you up at night, you may need a more defensive strategy. If you remain calm and focused on the long term, you might be comfortable taking on more risk. Your emotional response to market swings is just as important as your financial ability to take risks. If a single bad day in the market can ruin your mood, your strategy is out of alignment. You can increase your risk tolerance through knowledge. The more you understand something, the less fear you will feel towards it. This is the same for investment. The more you understand the market, the more comfortable you'll be with its cycles. Invest in what you understand. Then, keep learning. But also, through experience. See how markets react to news events and watch both rational and emotional waves affect the value of companies. Let's take Amazon as an example. You may have heard something like, if you invested $10,000 in Amazon in 1997, it would be worth around $38 million today. That's a 33% return per year. Sounds like a great investment. So why not put all your money into something like this and just wait? Let's see. In mid-1997, you buy Amazon stock at $0.07. By mid-1998, it soars to 35 cents, a 5 times return. Do you take profits or hold? By July 1998, it's over $1. Do you exit? By September 1998, it drops to 60 cents. Do you hold on? By January 1999, it skyrockets to $4.60, then crashes to $2 within a month. 3 months later, it hits $5. Then the dot-com crash in 2000 brings it back to 60 cents. From that point, it took 7 years just to return to its 1999 highs. How many investors from the late 90s actually held on? While Amazon delivered an incredible return, most people don't consider the volatility, the drawdowns, or the fact that many other companies from that era went to zero. The lesson? Surviving drawdowns is just as important as picking winners. If you can't hold through the dips, you may never reach the peaks. Now, let's explore how we can match your risk tolerance with your investment strategy. Previously, we discussed broad market ETFs. Why stray from them? You don't have to. If broad market ETFs align with your risk tolerance and time commitment, they may be the best fit. However, if you want to adjust your risk level, consider structuring your portfolio into 3 parts. Core portfolio, the foundation. Broad market ETFs, diversified, low cost, and steady growth. Provide returns through capital appreciation and dividends. Defensive portfolio, the shield. Bonds, defensive ETFs, dividend stocks, or cash-like investments. Lower volatility, stable income, and protection during downturns. Reliable dividends and high-quality bonds keep paying even in rough markets. Offensive portfolio, the spear. Growth stocks, small caps, emerging markets, or even crypto. Higher potential returns but with greater uncertainty. Requires the ability to handle large price swings. Cash can also be offensive, ready to deploy in market downturns. The size and composition of each tier depend on your personal risk tolerance and goals. Once you establish a framework, you can tweak it to fit your needs. Want more defense? Add bonds, dividend stocks, or cash. Would prefer a more aggressive stance? Lean into growth stocks but keep a defensive cushion. Prefer balance? A hybrid mix lets you take some risks while staying grounded. And if you're eyeing new trends, take it slow. Test the waters before committing. There is always a chance to be wrong about the company or the timing. But if you understand the investment, you will be committed to the long-term story, and you will not sell your ownership because the company has had a bad quarter or year. The key to long-term success is full commitment to your strategy. A successful portfolio is like a disciplined army. It thrives on a well-defined strategy. The worst mistake? Abandoning your plan due to fear or hype. Find a strategy that matches your personality, stick with it through market ups and downs, and let time work in your favor. Investing can be simple or complex. It's your choice. With just 3 ETFs, broad market, high yield, and growth, you can build a diversified portfolio. Then, focus on increasing your contributions by investing your time in your career or business. So, what strategy works for you? Defense or attack? The key isn't choosing one. It's committing to your approach over time. Are you a defensive or aggressive investor? How do you balance safety and growth? Share your thoughts in the comments. I'd love to hear from you. Be industrious, brothers. Are you ready to join us on this journey? Are you ready to win? If you're enjoying this content, show some love, hit the like button, and give it a thumbs up.